Welcome to the channel. In today's video, we're taking a deep dive into one of the most essential tools for smart investing, fundamental qualitative analysis. Numbers alone aren't enough to predict a company's future success, and that's where qualitative factors come in. We'll be exploring everything from leadership and brand power to industry trends and corporate culture, all factors that could give you an edge in picking the right stock for long-term growth. Stick around for the next few minutes to learn how to apply this analysis in your investment journey. Let's dive right in. To start, let's clarify what qualitative analysis is and how it fits into the broader scope of fundamental analysis. Typically, investors focus heavily on quantitative factors like earnings, revenue growth, or price-to-earnings, PE ratios. But while numbers are important, they only tell part of the story. For example, you could have two companies with identical revenue growth, but one of them may have much stronger leadership or a better brand reputation, which could make it a far better investment over time. That's where qualitative analysis comes in. It involves analyzing factors that can't easily be quantified, such as management quality, brand strength, competitive position, and even corporate culture. These factors, though intangible, play a huge role in a company's long-term performance and resilience, especially in rapidly changing industries. Let's start with one of the most critical qualitative factors, leadership and management. The people steering the ship have an enormous impact on a company's success. You want to invest in companies led by visionary leaders who not only understand their industry, but also know how to innovate and adapt in a constantly evolving market. Take Tesla under Elon Musk, for example. Musk's leadership has pushed Tesla to the forefront of the electric vehicle, EV, market. His bold vision and risk-taking have allowed Tesla to outpace competitors like GM and Ford, who were slower to adopt EV technology. Tesla's stock has surged because Musk didn't just follow trends. He created them. Conversely, think of General Electric, GE. Once a market leader, GE has struggled in recent years, in part because of poor leadership transitions. Mismanagement of resources and failure to innovate in key sectors led to a decline in its stock value and overall market share. When analyzing a company, ask yourself, how experienced is the CEO? What's their track record? Do they have experience leading companies in similar industries, or are they trying to turn around something completely new? Another key question is, how is the management team structured? A strong leadership team isn't just about the CEO, but also about the CFO, CTO, and other key executives who keep the company running efficiently. Next, let's talk about brand strength and reputation. A strong brand can serve as a company's most powerful asset. It's what gives companies the ability to charge premium prices, maintain customer loyalty, and expand into new markets. Take Apple, for instance. Apple's brand is synonymous with quality, innovation, and style. Because of this strong brand identity, Apple can charge higher prices for its products than many of its competitors, and it still manages to have some of the most loyal customers in the world. When they release new products, you'll see people lining up to buy them, even when those products are priced much higher than the competition. That brand loyalty translates into steady revenues and higher profit margins. However, reputation can be a double-edged sword. Volkswagen is a good example here. The 2015 emissions scandal severely hurt Volkswagen's brand reputation, leading to plummeting sales and a drop in stock value. It took the company years to recover from the damage. To assess a company's brand strength, ask, how loyal are their customers? Is the brand recognized worldwide, or is it only popular in certain regions? Does the brand have a positive association, or are there controversies that could damage its reputation? Now, let's discuss competitive advantage, often referred to as a company's moat. In investing, the term moat describes how well a company can protect its market share from competitors. A company with a wide moat has something unique that makes it difficult for others to replicate or compete with. A classic example is Coca-Cola. Their brand is globally recognized, and they've established an unparalleled distribution network that makes it nearly impossible for new entrants to challenge their dominance in the soft drink market. Even with numerous competitors, Coca-Cola's brand loyalty and global presence protect it from significant threats. But moats don't always come from branding alone. Take Microsoft. Their moat comes from the fact that their products, like Windows and Microsoft Office, are deeply embedded into the workflows of businesses worldwide. It's hard for companies to switch from Microsoft products because the cost of switching is high in terms of both training and integration. When evaluating a company's moat, consider: does the company have patents, proprietary technology, or exclusive contracts that competitors can't easily duplicate? Are their customers highly dependent on their product or service, making it harder for competitors to steal market share? Industry trends are another critical qualitative factor to consider. Even the best company with stellar management and a strong brand can struggle if it's in a declining industry. Conversely, a company in a growing industry has the wind at its back and can benefit from tailwinds that make growth easier. For instance, the renewable energy sector is booming as governments around the world push for greener energy solutions. Companies involved in solar, wind, and electric vehicles, like Tesla or NextEra Energy, are well positioned to capitalize on this growing trend. On the other hand, industries like traditional coal mining are in decline due to regulations and shifting public sentiment, which limits their growth potential. To assess a company's position in its industry, ask: is this industry growing or shrinking? What are the major trends impacting this sector, like new regulations, technological innovations, or shifting consumer preferences? You also want to look at where the company ranks within the industry. Are they a leader, or are they constantly playing catch-up? Finally, let's look at corporate culture and innovation. A company's ability to innovate and maintain a positive workplace culture can drive long-term success. Think about companies like Google or Amazon. Their cultures encourage creativity, risk-taking, and constant improvement. Google, for example, is known for giving employees time to work on their own innovative projects, some of which have led to major product launches like Gmail and Google Maps. Companies that invest in research and development, R&D, and create an environment where employees are encouraged to push boundaries tend to stay ahead of the competition. When evaluating corporate culture, look at factors like employee reviews on sites like Glassdoor, awards for being a great place to work, and the company's history of innovation. Does the company continually release new products or improve existing ones? Are they leaders in their field, or are they always following others? In summary, qualitative analysis gives us valuable insight into the intangible factors that can make or break a company's future success. From strong leadership and a well-established brand to competitive advantages and an innovative culture, these are the kinds of factors you can't measure with a balance sheet but are critical for long-term growth. I hope you found this in-depth guide helpful. If you did, don't forget to like, subscribe, and share this video with fellow investors. And if you have any questions or want to dive deeper into any specific topic, leave a comment below. I'd love to hear from you. Thanks for watching, and until next time, happy investing.